Good evening, this is Hamzei. I'm just doing a quick test of a screener. This is our SP1 Momo chart. We have three sub panels here, if you will. SPX weekly and daily, and we have SP1 and Momo. What we're looking at is a 2 sigma pattern on a weekly SPX. 200 bar is this white line coming in very thick. That's what we failed in February, and we came up for a retest right before election time. Next we have SPX daily, and again 2 sigma pattern, 2 standard deviation from a 20-day moving average, 200 bar MA here. And here we have SP1, which is a proprietary indicator we use for measuring breadth of S&P 500 components. The 500 names in there, not the whole market. There's too much noise. There's ETF and all that in NYC. We're just strictly looking at SPX components. It's a long-term view of the SPX there. I mean the advanced decline differential of SPX, if you will. And Momo is a faster brethren of it. Why? We're trying to use one as a signaling to the other. You know, as for example, as we saw here, so we ran up into April of last year, you're seeing the Momo getting less and less and less, so which signals a drop. And of course, this we went through this on every other week in our webinar, so that created a signaling for us that we use to suspect a top is coming here in conjunction with other indicators. But that's basically the concept here, the bearish divergence. That is, the one indicator is rising, the long-term one, and the short-term one is failing. So even though we're going higher and higher, the momentum is getting less and less, and we get to a asymptotic return, and we reverse down. Now, in the bottom, we also have some 52 weeks high and lows. The new highs, new lows for, again, SPX only, the SPX components. We have CI here and CI diff, and as you see, both the weekly and daily are pointing up, and they're red. So, and the diff is turning up, and diff is turning up here. So for time being, we're staying long with our call here with timer digest. Now intraday, you have to trade it as it comes to you. You know, you gotta see what. You got to trade what you see. Do not try, you know, analyze every news and try to say it's got to do this, it's got to do that. No, market does not have to do anything. One thing market will do is steal your money right in front of you. So quit analyzing too much. Okay? Yeah. Don't sit there and read all these websites and try to make an economic analysis out of it. Most of those guys are just talking. Okay? They're not trading. Get real. Pay attention to order flow, pay attention to advanced decline, look at your internals. You're here to make money, not to render an economic opinion. Now, where are we heading from here? I want to see this the put call to stay low. I want to see the new 52 weeks high to stay moderate. I don't want to be rising. If it gets over 100, I'll be panicking, as I did earlier here. That was a week of elections. You got to keep it moderate moving forward. Obviously, right now, we don't have to worry about 52 weeks lows. That's a problem. Later on, as we drop, eventually we will. All rises will lead to a fall. As we drop, when they start rising, that's where the bottom is. Okay, you can see it here very clearly when we got into quite a bit of activity in this summer of 2010. This is where the issue was, and of course in the data you see it more detailed. But anyhow, for now, I would suggest you stay on the long side. Good trading, pay attention to details, and we'll talk to you soon.